The biggest mistake traders make between 11 a.m. and 2 p.m. is buying breakouts, because 80% of strong moves in this window fail and reverse. The market breathes in a rhythm. After the violent energy of the morning drive, we enter the midday doldrums, typically occurring between 11 a.m. and 2 p.m. Eastern Time. The defining characteristic of this period is a significant drop in volume. Institutional traders step away for lunch, removing the driving force behind sustained trends. When volume drops, the market loses its inertia. Trends that looked unstoppable at 10:30 a.m. often stall, and the market enters a state of confusion or equilibrium. This creates a trading range environment. In a trading range, price action is bilateral. Neither the bulls nor the bears control the market for long. The most critical rule for midday trading is to change your mindset from trend following to fading. We expect breakouts to fail. In a strong trend, we buy high to sell higher. But midday, buying high usually leads to being trapped at the top of a range as price reverts to the mean. Therefore, our execution logic must shift. Stop orders, which enter on momentum, are dangerous here. Limit orders, which enter on pullbacks, are superior. Let's look at the second leg trap. This is a common pattern where a midday breakout has a second push, convincing traders the trend is resuming, only to reverse. Here is the visual anatomy of that trap. The first leg breaks out, pauses, and the second leg hits a measured move target before aggressive selling returns. If the morning trend was very strong, midday often forms a wedge flag. This is a pullback that lasts for hours, drifting against the main trend. This wedge is technically a bull flag, but it is tedious. The entries are often obscure, and the bars overlap significantly. Patience is the only edge here. A specific danger zone to avoid is barb wire. This is a sequence of 3 or more bars with bodies that largely overlap and prominent tails. Trading inside barb wire is gambling. The probability of a successful scalp drops to 50-50. You must wait for a clear breakout and, crucially, a follow-through bar. Because volatility decreases, your stop-loss distances might need to be wider relative to the bar sizes to avoid getting shaken out by random noise. To compensate for wider stops and lower probability, experienced traders often reduce their position size during these hours. Another technique is scaling in. Instead of a full position at once, you enter a starter position and add if the market moves against you within the range limits. However, scaling in requires expert judgment. If you mistake a trend specifically for a trading range, adding to losers will destroy your account. Often, the best midday trade is the vacuum test. Price gets sucked rapidly to a magnet, like a moving average or a previous high, just to test it. These vacuum moves look like breakouts, but they are exhaustion moves. They run out of buyers or sellers exactly at the support or resistance level. If the chart is unclear, zoom out. Switching to a 15-minute or 60-minute chart can filter out the 5-minute noise and reveal the true structural levels. As we approach 2 p.m., be alert. The midday doldrums often end with a reversal or a resumption of the morning trend as institutions return. We often see a failed breakout of the midday range that leads to a strong trend into the close. This is the trap and reverse setup. To summarize, midday is for scalping, not swinging. Buy low, sell high, avoid the middle, and use limit orders to fade weak breakouts. If the price action is confusing, the most profitable position is flat. Preserve your morning capital and wait for the clarity of the final hour. Respect the range, fade the breakouts, and stay patient.